We have a situation underway here where stocks are plummeting. Futures indicating a decline of 500 points at the opening of trading this morning. The Dow Jones Industrial Average right now down 563. The Nasdaq is down 190, and the S&P lower by 72. European markets this morning are lower, led by a sell-off in Credit Suisse. Worries about Credit Suisse has all the major banks in Europe down. The FT 100 is down 205. The CAC 40 is down 251, and the DAX index lower by 409, as you can see there. Joining me right now is Piper Sandler's chief investment strategist, Michael Kantrowitz. Michael, good to see you. Your thoughts on what's playing out this morning?
Lots going on, and there's a lot of uncertainty that continues to build, not only in the U.S. banking system, now in the European banking system. I think the bigger picture here is that, we've been in a backdrop, and we will continue to be in a backdrop for some time as the lagged effects of all of these policy tightenings from central banks, from commercial banks, and from inflation create the conditions for problems to happen. And so I think, this is one of several problems that we're going to be seeing down the road. Most of these are due to higher interest rates. Historically, the big problems arise when job losses occur, which unfortunately is a typical byproduct of the lagged impact of higher rates. So, our message to investors has been for quite some time now to be quite defensive and conservative, and that we still believe we're in a bear market, and investors shouldn't get too complacent on this idea that the economy is anywhere near recovering on a global basis.
So do you expect more bank failures?
In the U.S., I think the FDIC has explicitly backstopped the two specific banks that have failed. I think that's an implicit backstop for other banks. I'm not a bank analyst. I don't think that the government is going to allow a systemic problem to unfold like '08. The problems in the banking system today are different than '08 for sure. And it's a combination of higher rates and the long-held assumption that rates are going to be zero for a long period of time. And one interesting stat is that the last time we really saw a broad-based tightening cycle like this was a record 16 years ago. When you go throughout history, 16 years is the longest time in history between the types of tightening cycles we see today in commercial and central bank tightening. We hadn't seen that since '07.
Adam.
Michael, Adam Johnson here. And by the way, you have been consistent in your calls for caution, and you've been right. So I commend you for that. My question is, you talk about that 16-year tightening cycle, but is it possible that we're actually about to see the end of this tightening cycle because falling asset prices, falling bank stocks, and falling markets will ultimately force the Fed's hand and force them to stop raising rates?
Yeah, so just to clarify, the 16 years is the last time we saw a tightening cycle like this, which is a historic period of time, which means that, I guess unless you're 35 years old or older, you haven't been employed and seen something like this. And even for those of us that are above the age of 35, our muscle memory has weakened to recency bias of soft landings. And so, yeah, if things continue to escalate, that's going to be a pressure for the Fed. The one thing we have to keep in mind, everyone's bringing up, well, look, the Fed cut when LTCM imploded in 1998. CPI was 1.68 when that happened. So there was nothing holding back the Fed from jumping in and cutting rates aggressively in the middle of 1998. Today, obviously, a very different story. So the Fed remains between a rock and a hard place. We saw CPI yesterday. Core services, ex-shelter and healthcare was quite hot. But I think the ultimate answer to your question, Adam, is that even if the Fed were to stop today, even if the Fed were to cut today, there's a lagged effect that has to play out. And then there's banks' lending standards, which is the other tightening cycle that is, I don't see how banks don't further tighten their lending standards. And so we often give the idea that, it's like when you're eating a big meal. When you're finally done eating that meal, that doesn't negate the fact that you've overeaten and you're going to get a stomach ache. And perhaps we've over-tightened like the Fed has done historically, and they usually tighten until something breaks. I'm not sure if this is it, But again, we have to look beyond 40 years of history to understand the reaction function of the Fed today, because we have an inflation problem still.
Yeah, and it's also the shock of the speed, which is under a year. It's going to be 1 year on March 17th, Tiana, that the Fed started raising rates.
So the Fed has made clear. The Fed has made clear that they're going to have additional funding available for these banks if there is sort of a contagion effect from the Silicon Valley bank fall. Does the Fed making clear that they're going to bend over backwards to help these lenders who need to make sure that they can fulfill their deposit obligations, does that increase the odds that the Federal Reserve will stay the course, especially considering that core inflation, that core CPI acceleration? Or does this just mean that we are in for the ephemeral pivot?
Yeah, I don't think a 25 or 50 basis point rate cut really solves anything. Ultimately, that's, I think if the Fed would have cut rates and saw that as the solution, we would have already seen it. And we haven't, obviously. That doesn't mean that can't be a future event if things unfold more dramatically. But, when you look back in history, you got to be cautious. In 1998, when the Fed cut rates on LTCM, oil tripled over the next year. And so, that's a risk that if the Fed starts backing off while the rest of the world is still tightening, the dollar weakens and oil goes up, and then we have a different problem. So, again, there's a multitude of tightening cycles taking place here. It's not just about the Fed. And I think they're really stuck right now, which is an unfortunate position.
Well, you're right. I mean, you're talking about the consequences of bad policy. Michael, it's incredible the amount of impact we're watching play out here. Thanks very much for weighing in on all of that, Michael. Good to see you. Michael Kantrowitz joining us. Bye.